what's happening at like Citadel Securities or Susquehanna or Virtu or Jane Street. There's just an absurd amount of money being made by relatively few people. And again, the Sharpe ratios, if you are in the hedge fund business and you have like a 1.5 Sharpe, you're kind of a stud. There are high frequency firms that have a Sharpe ratio of 20. So what you're really looking at is that gearing that comes with lack of scalability sometimes. That can be quite useful. And, you're looking to capture edges where really big firms can't really deploy those types of edges. And it really is the idea of, is it better to make, you know, X amount and you keep all of the money, or is it better to make the percentage of, 50x the money? Well, in theory, the 50x the money. The hard part is getting 50x the money. So that is the eternal trade.
Before we get started, I just want to do a quick disclaimer that nothing we say here is marketing or advertising for Convex Asset Management or any of their funds or products. Everything is meant to be educational and informative about the fund management industry. Welcome to another edition of Other People's Money. I am joined today by Noel Smith, the CIO and founder of Convex Asset Management. Noel, thank you so much for being here today.
Thanks for having me.
All right. Well, I'm very excited to discuss two different types of money management. The show, obviously, it's called Other People's Money. We're very focused on fund management and the idea of managing other people's money. But you have a ton of experience on the prop side of trading, which implies that it is not other people's money. It is often other people's money if you're working for a prop firm. So there is, some aspect of that, but it is very different than managing money from the fund side. I know that you started your career really on the prop side. So why don't we go back and explain to people what exactly proprietary trading is and how it differs from the traditional fund management industry.
So prop trading is just kind of doing what you want. Think, you have your own Schwab account and nobody's really going to tell you if you want to buy Tesla or Tesla calls or short Tesla calls, whatever. You can kind of do whatever you want. So running my own money is really what I did for almost my entire life up until recently.
Prop firms, I mean, there are a lot of prop firms that employ a bunch of people. So you are running somebody's money still. When you were a prop trader, did you employ other traders? Did you have splits with them?
Yeah. So I'll give some context and background so that it kind of flows and makes sense. I started out in 1996 on the floor of the CBOE. I was one of those guys that you see in a wacky jacket standing on the trading floor. And the money that came from that was initially supplied by my business partner. He had, not a lot of money, but some, and I had none. So he asked me to kind of come around and, he and I started the firm. And then as we had some profits, we started to back other guys. So think of it as like, the Max and Noel firm, right? We each put in $1,000 and then we run into Bob and Bob trades something else that we like. And we think Bob can make money too. So we decided to back Bob. And, that's now we're, a 3-person firm, your money, my money, but Bob didn't have any money. So he just said, hey, listen, I want to trade, bonds. And, so we break off some money for Bob to do his thing too. So now it's still our money. We're not looking for outside money. We don't even want outside money because that invites a whole nother, hornet's nest of problems. But we are in the business of backing other people. And I've backed north of 100 guys, not by how many, maybe it's 101, maybe it's 110. But I've had guys really in all the major products over the years, at various exchanges, really in every options pit in Chicago, Board of Trade, which is bonds. We had Eurodollars, which is which is now SOFR, which is at the Merck in Chicago, the COMEX, the NYMEX, the AMEX, kind of all over. So I've had guys representing my capital really in all of those pits or those organizations at one point or another.
I'm sure there are a bunch of people listening to the show who would love to get backed by somebody to go take risk and trade. How are you finding these people? Are they people who are maybe working for another prop? Like, how does one get into that world of being backed?
I don't know what the best path is nowadays, but back then, I worked in a building called One Financial Place, right? So as you can use your imagination, it's basically a 45-story tower with nothing but hedge funds, prop trading firms, market making firms, that kind of thing. So, eventually you just run into somebody. It's like, hey, I trade, corn at 3 a.m. for Citadel, or I work for Susquehanna or whatever else. You just get to know people. And then as people either quit because of whatever reasons, or they get fired for whatever different reasons, You just say, hey, listen, there's somebody else we know. Just like, how do you find a new person to work for you? My cousin knows a guy, and that's kind of how it works. And like anything, we did recruit out of college. Um, we recruited out of, top tier schools, which actually had less success than secondary tier schools. Like we had really good success out of University of Illinois, University of Michigan. When it came to some of the Ivy League schools, we had less success. And we built traders that way when we couldn't, buy traders the other more traditional way.
What is the starter capital when you're bringing somebody in? And I'm sure it differs between taking somebody out of school who maybe has to be taught and learn on the job versus somebody who like you said, you've met in one financial place and you know that they trade and they have a product that they're, they've been trading for years. How much capital are people getting? And, what are the economics like?
So the economics of the capital is different when it's your own money because it's not about like, here is a pile of money. It's yours. No, don't blow it up. It's more like, okay, we have this pile of money. We're going to apportion some of that risk to you. So risk capital is not the same as notional capital. So say you have $100 million in your account, and you want to give $1 million to Bob. Well, you don't actually take $1 million and put it in Bob's name. What you do is say, okay, Bob, you can, apportion $1 million of risk. And there's a lot of different ways you can do that. Like say, for instance, you have, you want to be long Apple. Well, do you go out and buy $1 million worth of Apple? Do you go out and buy $1 million worth of Apple calls? That notional out, it's like $50 million, right? Those two things are totally different. So, and that kind of is a conversation that you have internally, which is what do you think of the merits of the trade? And, what is your track record in being long Apple calls versus being long Apple? And so you're really looking at it as a function of what can they lose? Because the gains kind of take care of themselves. But what you really want to do as a backer is figure out, okay, how does this guy blow up? And in some totally random, sequence of events where you're going to end up losing way more than your $1 million in this example. So, say for instance, you think that the most Bob can lose is $1 million, but now he's down 20 million bucks. That happens. So that's what you really have to, be aware of. And that's really a more accurate way of thinking about it. And the second part of your question is like, how does the breakdown work? Typically it's a split. So you start out with something like, okay, again, we're going with hypotheticals, but, say here's $1 million, Bob, of risk capital. And if you make 500,000, then, you get to keep 35%. And then if you make another, 500,000, now you're at $1 million total net profit, we'll bump you to 50%. And then if you end up being, $3 or $4 or $5 million in, total gross profits, then we'll give you some kind of a higher split. And then there's usually an understanding that if you get to the higher splits, you keep some capital in your account so that, if things do go sideways, you just don't rip through all of firm capital right away. By the time that somebody is in that position, they're usually a trusted asset. And even if they do lose money, you kind of know the reasonings why. And if it is smart judgment or good trades that got you there, you might even add.
Are you thinking in percents? Are you thinking in dollars? Obviously, different strategies have different capacity levels. You can make somebody might be able to make 100% on a small amount of money versus, hey, this guy can consistently make 10, 20% on a lot of money. Like when you are thinking about backing people, is it all about the dollars?
In the prop space, nobody cares about your 10%. Okay.
Okay.
That's for T-bills. What you're looking at is the risk capital. In other words, how much you're going to lose, how much you're going to make in any one given time increment. And, what is this going to do for me? So typically, if going back with our $1 million example, the idea that you buy $1 million worth of Apple calls is more likely than just spending $1 million on Apple. Those two things, if Apple goes up 10%, you make your 100 grand. If, Apple calls go up 10%, you might make, another million or whatever. So what you're really looking at is that gearing that comes with lack of scalability sometimes, that can be quite useful. And, you're looking to capture edges where really big firms can't really deploy those types of edges. If you're running Millennium and, you have, $500 million doesn't even move the needle for you. If you make $300 million in profit, you get an attaboy, but does it really move the needle for Millennium? I mean, barely. So why are you goofing around with these small little trades, right? Like I'm going to sell, 300 Tesla puts. So doesn't matter. So you have to start to think big picture. But when you're running I call it sub $100 million of prop capital, making an extra $2-3 million. Yeah, that's great. Because if you have $100 million of capital, in any one given time, you're probably only risking 20 or 30 or $40 million. So, to make $3 million in any one given trade, that's a fine day.
Yeah, and are you pulling obviously, if you're doing these smaller capacity constrained strategies, is it you're pulling money out every year, you kind of run up to a level and then you scale it back down? How does that work?
I don't think there is any one answer. I kept probably 95% of my net worth, probably more, in the firm for years. I didn't pay myself for, 2, 3 years for sometimes. And, also that firm capital, like we did other things with it. We invested in other companies. We got involved in high frequency trading. I've done probably, I don't know, 11, 12, 13 different VC ideas, 10 of which have gone to zero. So, you have all kinds of things, when you have some success and people know about it, you get people dive bombing you out of the blue. Hey, listen, I want to go drill an oil well in Oklahoma. All right, great. What's the merits of the trade? So, those types of opportunities present themselves to you.
You've moved on from the prop world, at least in some capacity, and now you have Convex, and Convex manages other people's money. What was it that made you decide to move away from this prop world into the world of OPM?
It's funny. There's specific stories. I met a guy who wanted to launch a hedge fund years ago. I'm still friends with the guy. And he launched a hedge fund, and I'm like, "Good luck to you, man." And, when he first started doing it, he was really struggling. He couldn't really make any money. And, about a half a dozen years later, he did really, really, really well. And he's doing fantastic right now, just unbelievable. And it wasn't so much, he was willing to sacrifice a way larger chunk of time to get to scale than he thought or I thought. And it really is the idea of, is it better to make, you know, X amount and you keep all of the money, or is it better to make the percentage of, 50x the money? Well, in theory, the 50x the money. The hard part is getting 50x the money. So that is the eternal trade. You want to do something at scale. Does your strategy scale? So, going back to like, why would I do this? And part of the reason even that this interview exists right now is because my other partners, when we were prop trading or even high frequency trading, they eschewed the media. We all eschewed the media. We didn't want to talk to anybody. And it was not in any of our best interest. It was kind of douchey and self-aggrandizing, and nobody wanted to do it. And so that was just part of, our business. But I thought that if I ran a hedge fund and I was asked questions publicly by the media, the press, whatever, I could answer them and I would present at least okay. And I thought I could do that part of the job. I thought the money raising part would be easier than what it is. And I thought that I could scale. So all of those things kind of combined, and with some of the people that I've known that have launched hedge funds that have been successful doing it, well, I thought, well, I can do that. And then I know other hedge funds that I feel like they don't even do anything all that spectacular. Then they make, 8% a year. I'm like, yeah, I can do better than that. I can build a better mousetrap. So it was really kind of common sense, which is like, I think I can do it. And, that's it. I think I can do it. I think I can be successful doing this. And, the jury's still out whether or not that'll end up being the case.
How has asset gathering gone, and what do the people who are interested in some of these more prop like strategies look like? Are they people from the prop world who've done very well, who, see it similarly to backing, backing a trader? Or are these people who, don't have access to that prop world, who, you provide an avenue to get into some of these strategies that, are not as common in the hedge fund world?
So capital raising has gone way harder than I thought it would have been. And, whenever somebody, if I'm listening to this podcast in the future and someone says to me, "Hey man, I want to launch a hedge fund," I am one of those guys that almost always like, go for it. I want to become a movie director. Go for it. I want to become a rock star. Go for it. I'm never one of these guys that says, "Hey, it's hard to become a rock star. If you think you can play guitar better than, Jimmy Page or whatever, then, that's what you got to do." There is a nexus of preparedness, luck, timing, all of these things that, we really need to have kind of come together. And it is more difficult than I ever would have gambled for. So my returns as a prop trader were fantastic, by any measure. And so I thought I could map that to capital raising. Wrong. It's much harder. And, the prop returns aren't really applicable. So there's that. And the people that you're talking to, people that we've responded the best with are the highest tranche of sophistication. We resonate the best with market makers, prop traders, guys that kind of have my same background, because they can identify whether or not we're full of crap instantly. just no nonsense. You can cut through. If you've been doing something for 30 years, the idea that somebody's going to get in front of you and BS their way through a conversation is asymptotically approaching zero. It's just not going to happen. And if you start to, get some red flags in the conversation, you drill a little deeper and you figure out, okay, does this guy really know what he's talking about? What happens if this happens? What happens if that happens? And you go through all these different combinations of scenarios where you can make or lose money, and you can figure this out really, really swiftly. So we tend to do the best with the hardest questions in the wackiest scenarios. Like, how do you make money when, Mercury's in retrograde and there's a spaceship flying overhead? Well, this is how we lose money. Great. And also, I think that the prop trading community really respects people that cut to the chase and say, okay, this is how we lose money. And if somebody tells you they can't lose money, they are lying. It just doesn't exist. And so that we really do click best with like the single highest tranche of investors. We do poorest with people that are the exact opposite of that. A quasi retail type of investor or a family office that, made money selling drywall in Tulsa. And, they have, $1 billion now and they want to get into the marketplace. Well, we get in front of them, explain what we do. And they're just like, I have no idea what you're talking about. That makes no sense to me. And it's not that they don't believe us. It's just that they're not equipped to really ask the questions or understand the answers. It's not because I know anything more about drywall. It's not even being like, we're so smart or they're so dumb. It's just like, they're outside of their comfort zone. And we typically don't get allocations from firms like that. And so usually the more sophisticated, the better, which I think, frankly, is a weakness of our business. And maybe my messaging.
So I guess, is there any time you've been able to cross that chasm with somebody who's perhaps a little bit more retail?
See, that's part of the reason I do podcasts. It's to build credibility. So, if somebody doesn't know you, like I come out of the prop community in Chicago. So, people that know me in Chicago or works for me in Chicago, like, yeah, those guys did really well. Other than those people, nobody has any idea who I am. So, you get in front of some guy and you're like, again, drywall guy in Tulsa. And you say, okay, I made X thousand%. He's like, did you really? That doesn't sound true to me. And then you kind of go through that, conversation and you pull on that thread. So what you're really trying to do is build credibility. You show the numbers. Well, the numbers are just table stakes, right? Everybody shows their numbers. And then you have to just be able to build a rapport with these people. And I guess one of the things that I was most wrong about, because I've hired people that I don't even really like. I don't really care if I like you. That's not relevant to our business. So if you come to me and you're a total weirdo and you want me to back you, I don't care if you're a weirdo. My ex-partner, he was like, he had a lisp, he had long hair. If you met this guy at a restaurant, you'd be like, what? Who is this guy? And he actually was a really good, really, smart guy, good trader, made a ton of money. But it's not a personality contest. And I thought that the capital raising business would be more similar to that. It's not. It almost is a popularity contest. You have to be able to interface with these people and build a rapport that really isn't about the merit of the trade. In other words, if say you're up, 10% and someone else is up 12%, does that really matter? Not if you're cool. They'll take your 10% as opposed to the superior 12%. Not everybody, but you have to, it's like dating, not everybody's the same. Some girls want to play golf. Some girls want to, shoot guns. Some girls want to, swim in the river. I don't know. And, you have to be able to adapt each one of those types of scenarios. And it is much more about relationships and way less about the merit of the trade than I ever would have reasonably guessed.
And so, obviously you're doing the podcast. I know you do the EQ Derivatives conference. I'm sure there's plenty of people who are trying to get their name out there. How do you get to be a speaker at a conference like that? And, is that a good place for people who are trying to build relationships with people?
I have never asked to do anything like even this podcast. You guys said, hey, you want to do a podcast? I said, sure. All of my podcasts have been like that. EQ Derivatives is one of the conferences I've spoken at, and those dudes are just like, hey, they're not they're dudes, they're female. But hey, we have this thing going on. Do you want to come talk about whatever it is you talk about at our thing? And I'm like, okay, sure. And I just kind of show up. I do my little speech and go around. I would say that I've raised, well, I shouldn't say, I would say I have raised zero money from those types of conferences. I think it does raise your credibility, but can you cash credibility checks? No. Is it a necessary part of the business? It's tough to say. I think if you don't do those types of things, you need to have something else that makes up for that deficit so that people can identify you as being a real entity in the space. Are you credible? Are you accountable? Do you do what you say you're going to do and those types of things? It is easier if you're willing to go on stage, speak to a crowd of professionals and be scrutinized by them writ large. So I think that does make things a little bit easier, which is why I do it. But is it a path to, raising AUM? Not for me, it hasn't been.
You talked about how the returns don't map from prop, but do the strategies map? Are you able to run similar strategies? Maybe the scale of it makes it so that the returns aren't the same, but the still the same type of trades, intellectually.
Yeah, totally. So the whole point of my firm is doing exactly that. What we're doing is we're taking best practices from prop trading, doing those trades that investors never really see in a normal hedge fund, and we're putting them in, an investable package. So that is really our sales pitch, our edge case. We're doing things that other people don't do, and we're giving you alpha as a result of these things, and you probably have never seen it. And the feedback I've had almost universally is that, yeah, we don't see this. You guys really are unique. Really, nobody has ever said, oh, there's 10 other dudes doing what you do. That's never once happened to me.
I call it the hedge fund category problem. Like if you go and you're reporting your returns to like Preqin or whoever, if you're long short and you're low net, like you check the box, I'm long short, we're low net, you fit into this nice category. And then if some allocator is using Preqin to source a manager and they're looking to write a check for long short, it's a big top of funnel. Like how do you deal with the fact that you don't fit neatly into a category?
Not that great because we are tagged as a volatility fund, which is true and also untrue. So whenever you're different, it's good and it's also bad. And if you're like, you say you're a music industry executive, in 1968, you want every band that sounds like the Beatles because that's what's making money right now. But what's really going to make money in the future isn't probably the Beatles. Nothing against the
Rolling
Beatles.
Stone, yeah.
Well, even the Stones are, they're not that different than the Beatles. I
Yes.
mean, Led Zeppelin's a little different, or Pink Floyd, they're a little bit more psychedelic. But my point is that in order to be successful in the future, you can't just be like everybody else. But if you're not like everybody else, people don't really understand it because by definition of that, you are innovating on some new level. And, we're not a long short fund. I think that being a long short fund would be very easy because I can say, I am a long short fund. And they're like, okay, I know what you do. But there's 7,000 other long short funds. So now how do you differentiate yourself from those 7,000 people in your peer group? Not so simple. So when we use options and a lot of other things to get our alpha. So sometimes that's a real benefit. And other times it's a detriment. It's a detriment because people don't understand it, but it's a benefit because nobody else is doing what we're doing.
I got a chance to look at the deck. You've got sort of like 5 core strategies that you have in this nice little Venn diagram. At the top, you've got vol arb and vol risk premium. Maybe you could explain a little bit like what is vol arb, what is volatility risk premium, and why do you think that what you do doesn't necessarily qualify you as a volatility fund?
So again, there's like 5 questions in there. We could spend an hour on each one of them. So let's answer them in order. What is vol arb? Well, vol is volatility. Okay. Arb is the idea that you're simultaneously buying and selling the same thing at the same time and you're making an edge. That's not exactly true. We're not doing that. We are doing things that are substantially similar, like saying, Coke and Pepsi, right? They're substantially similar, but they're not the same thing. So what we're trying to do in vol arb is we're trying to capture edges in things that are similar by a certain percentage so that we can make money on both sides in the trade. Um, and vol risk premium is a totally different thing. What we're really doing there is we're harvesting the risk premium that is embedded in options over time. And it's a way to make money when there's nothing else going on. So, the S&P 500's had a really good 2024. What happens if, we're in a Japan lost decade for the next 10 years and the market goes sideways for 10 years? Do we need the market to go up to make money? No. And those questions are answered within our deck really, which is, we try to have uh, a case for how we can make money, market up, market down, market sideways. And the other question you had in there, which is like, how do you do this stuff? Well, sometimes if you want to be long Apple calls, I'll stick with Apple because everybody knows what it is. Um, is it better to be long the calls, short the puts, short the risky, or long the stock? And sometimes you want to be long the stock, not because you love Apple stock or have any opinion about the iPhone, but because you think it's going to go up, but because of the options, not but because of the iPhone. And that's an interesting distinction because volatility to me, like people ask me, why do you trade volatility? Well, volatility is one of the very few things that is forward looking. It is a future market collective opinion about where things are going to go. Well, Apple price, it does that a little bit. The price of Apple stock, that is. Apple earnings definitely does not do that. It is a snapshot of what happened last quarter or what's been going on in the last 10 consecutive quarters. So it is a way to be more accurate with market calls. And those calls can be, again, they can be expressed in a multitude of different ways. And so we're using options as a way to make investable decisions that aren't always in the actual options themselves.
So you think that the pricing of options is more predictive of future price movements than, say, analyst estimates?
100 million% yes. There's no way you can sit there and watch CNBC for 10 years and do what the analysts tell you, and then you go stand on the floor of the CBOE and deal with the Goldman broker, the Morgan broker, the whoever broker, see their flow, and not have better trades. That is just impossible. The information you get from the options flow is way better than the analysts, and nothing against analysts. I think that they have a very hard job, but the quality of information that comes from the marketplace is way better.
And do you think that it's these people know something that these analysts don't know, or just the sort of like wisdom of crowds collective?
Sometimes.
Yeah.
That's why I don't trade biotech stocks anymore, because I've been smoked in biotech stocks way too many times. Um, that's the reason, right? Because some guy who's never trading options comes in and buys 10,000 out of the money calls. Next thing you know, the stock's up 500%. That's a real thing. Not to get dark, but we were short a bunch of airline puts going into September 11th, 2001. I had no idea September 11th, 2001 was going to happen, and we sold a lot of airline puts, and it almost put us out of business. So do I think the quality of the information is superior in the options market than the analyst community that is almost always paid for by the people that are benefiting from it? I absolutely think that. And anybody who says otherwise, we need to argue, because that's just not factual.
And so, like, using that 9/11 example, I mean, I think with hindsight, it's become clear that that the people who knew that this attack was going to take place, were betting in the options market against the airlines. And so you, as somebody who didn't know this was happening, you're looking at the pricing of these options and saying, this just doesn't look right. Like, there's, some heaviness in the options market. And that's why you were on the other side of it.
Of course, I was a market maker. And, we were making markets in, UAL, American Airlines, all the airlines at that time. And, say that, for instance, the volatility of the at the money put is normally 35. The numbers don't really matter. Then you sell, a 1% position at 35 volatility. Then they come back, like a day or two later, and they're paying 42 volatility. You sell some more. Then they're paying 53 volatility. You sell some more. Next thing you know, they're paying 80 volatility. Whoa, I know these guys are going to miss earnings. So, but they're buying what's in all of them. So they're not going to miss earnings across the board. Is it oil prices? We start thinking about all of these things. And now, if you remember, in 2001, the market has already kind of come out of the tech bubble and starting to go down. The market was already going down. Enron happened. So a lot of volatility was already pretty high. So the idea that someone would buy puts in something and pay a high vol was kind of, in fair play at that time. And so we had sold, hundreds of thousands of these things. And like I said, 9/11 happened. If the market actually did open that day, which it did not, we would have been out of business for sure. Not only that, but here's a little bit of trivia. I was in the World Trade Center the day before, which is just extra bananas. I was invited out by Goldman to go to the US Open, and I had lunch with somebody. It's called Windows of the World at the top of the World Trade Center. And then I flew back to Chicago that day. Next thing you know, there was a fire at the World Trade Center and everything else we know. But, that is definitely a real thing, getting back to the point, which is the options market is probably the first stop for nefarious information. And then if you can figure out what's nefarious versus what's hedging information. Now, that's an extreme example of nefarious. The other side of that might be, some pension fund that has a zillion shares of Microsoft in their book And, they've had a good year. They don't want to get wrecked. So they go out and buy a bunch of puts. Is that a good trade? Yeah, that's a great trade. And if you can figure out the difference in the caliber of information, what is nefarious and what is just a hedging trade, well, that's a business.
All right. And so how do you determine when you talk about biotech, like obviously there's a lot of approvals, regulatory approvals and testing that's going on to determine whether, this biotech stock, which are usually kind of like a binary pricing, like is the drug or the machine or whatever it is that they're building, is it going to work? Um, Clearly there's some areas where it's very difficult to determine what's nefarious.
And they're wrong a lot, which is why this biotechs are funny. So, think of it as it's actually called bimodal. So you have your normal distribution, right? And then in a biotech stock, you're going to take two of these standard deviation distributions and kind of scoot them to different, parameters, right? So if say XYZ biotech stock is at $100, well, it's going to go to 200 or it's going to go to 2. And you can kind of figure both of those out. And the marketplace is pretty clever and the marketplace knows that. But the timing a lot of times is hard. So vol will get bid up into some kind of an announcement. Then the announcement will be delayed. And then, a straddle that was, trading for $40 with the stock at 100 goes to like 4, the stock trading at 102. And it's like maddening for those people to buy a bunch of volatility and expectations for some big event that just fizzles. And that happens a lot too. So that's what kind of coaxes you into that. You see some of these trades happening, like, oh man, there's all kinds of edge in this situation. But then, once every 5th or I guess every 7th trade, wham, the stock does go to 200. You're like, oh shit, now I just got wrecked on this trade. And then, that's the deal, right? You live by the sword, you die by the sword.
How do you really determine whether something is hedging or nefarious? I mean, is it a knowledge of who the participants are in the marketplace? Does the flow look different? Is it just a hunch?
Well, that's the art of our business, right? If it was on the screen, everybody could see it. If it was in the data, then every program would scrape it. So knowing how to figure out the quality of the paper is a skill. It is a human skill that maybe will, be sussed out by AI or whatever. But for now, it's still something that is, a human skill.
I want to talk a little bit about how returns scale. So you mentioned that you can't generate these like prop level returns when you're running, larger pools of capital with other people's money. Like, where is the breakdown? Like at what level of AUM do the returns start to degrade? And then what is the point where it starts to look unattractive even to outside money?
The money that is made in prop, anybody listening to this who's not in the business will believe. Yeah, the Sharpe ratios are out of this world. The consistency of profit, the risks that are taken, and the profitability, like Jane Street, this is public. They just put out, they made $14 billion this year. Okay, well, how many employees do they have? How many guys are actually making that kind of money? So if you think about, what's happening at like Citadel Securities or Susquehanna or Virtu or Jane Street, there's just an absurd amount of money being made by relatively few people. And again, the Sharpe ratios, if you are in the hedge fund business and you have like a 1.5 Sharpe, you're kind of a stud. There are high frequency firms that have a Sharpe ratio of 20. Those numbers are just so far out of range that most people are used to ever hearing about. They don't even know that they exist. It's like having an NBA basketball game where the score is like 2,000-4. It just doesn't sound real. They exist. They exist for a variety of reasons. But they don't scale. And to answer the question, the number is something around $100 million before things really start to taper off, and depends on how. Are you trading futures? Are you trading options? Are you trading single name equities? Are you trading them in, is it latency arbitrage? How big can you scale and why? Well, there's innumerable answers to that question, but you usually aren't doing something with $1 billion that's going to have, a 10 Sharpe. If you're doing high frequency trading, it's usually sub $100 million, depending on, I'm talking about deployed capital, because you're in the future space or you're in something that has a lot of leverage. And, the idea that you can make $500 million on $100 million is fully in range. But the idea that, if you're running Millennium and you have $69 billion, that you can make $69 billion, you're almost certainly not. I don't even know how you would do that. If you gave me $69 billion today and said, make 30 billion, I'm like, I don't know, put a bunch of T-bills and buy some Apple. I don't know. It's a totally different game. And the shape of that return and the scale of it is it has nothing to do with each other. They're just totally different.
There's a guy on Twitter, Gappy, who talked about like, would you rather have a 2 sharp on a billion or a 15 sharp on like 15 million? I think was the question. Like, what do you think about that question?
If it's all my money, then again, a Sharpe ratio implies no drawdowns, right? Or low volatility and high beating of the markets. Doesn't really speak to the rips and the scalability. So knowing what I know answers the question, which is I'd rather have a 2 Sharpe on a billion, because the chance that I can do that with 2 billion is pretty high, and the chance that I'm getting a 1.5 or 150 basis point fee on it is pretty high. And also a double-digit Sharpe strategy is going to have alpha degradation probably, right? So if you could, convince me that there's no degradation of your alpha over the next 30 years, all right, that's different, I guess. That's a really great trade. But the market is unbelievably clever at figuring out what it is you're doing and taking that money from you.
Well, yeah, let's get into degradation a little bit. I'm sure strategies that you used when you started out in this business in the late 90s don't exist today, and you've had to develop new strategies and things that maybe you did even just a few years ago you can't really do anymore. How fast does this happen? Are there things that are evergreen that you think are going to be around, till the day the sun goes out?
So nobody's ever asked me this, but I'll give it an answer to the unasked question, which is like, what's my real alpha? My real alpha is the nexus of creativity, experience, and science. And that creativity, I'm a pretty creative person just by genetic nature, allows me to see or connect dots that maybe others don't see. I know a good friend of mine who works at a globally recognized firm is genetically way smarter than me, but his ability to be creative is way lower than mine. So would I rather have him be my employee or would I rather back him? I'd have him be my employee because he is extremely good at doing good things with what is known. He is not that good at seeing the unknown. If you asked him to decorate a vacant house, he'd be like, I'll hire a decorator, because he can't see like purple goes with yellow or whatever. And piecing together what's changing and how your alpha will degrade with time and coming up with new ideas or iterative tweaks on your alpha, to me, really is the job. So things that I used to trade got put on the shelf for a while, then they came back, right? Like I trade dispersion, and I traded dispersion, 20 years ago. And then the way I do it now, is it slowly different than what is it did 20 years ago? No, not really. Is it different? Yes, it is different. And I've tweaked it and I've iterated on it, hundreds of times. So it's a substantially different trade, but the core thesis is the same. And, even that trade ebbs and flows with time. Sometimes it does really well, and other times nothing happens. But that also speaks to like, why did I launch a hedge fund? Because if you're just running a dispersion desk at Citadel, well, if dispersion dries up, your trade dries up, and so does your money. So that's kind of the problem. But if you have multiple trades in your little toolbox, then you can kind of apportion capital where you think the opportunity set is superior.
And you use this friend of yours, hypothetically, like as far as personality types go, like is that route of going to a dispersion desk, say at Citadel, like the right move for some people? I'm sure there's a lot of people listening to this who want to be a trader, want to start a fund. Like, is that the right way for a lot of people to go?
For most people. Yeah.
Okay.
Launching a hedge fund, I know, this is about other people's money, isn't easy. It's way harder than I thought. And I came from a extremely good background. Well, I would say the second best background to launch a hedge fund. The best background is, you go work for a giant hedge fund. You want to go, hang out your own shingle, and they break off $1 billion for you and send you on your merry way. And they take some of the economics. That's the best way to do things. Or the best way is just be born into money. That's the best way, right? You just have this giant pile of money that your dad gives you or your mom gives you, and poof, you're rich.
Yeah, the family office route.
Right. So that's the easiest way. The second easiest way is to spin out of something else. And probably the third easiest way is to come from kind of my background, which is like, you worked in the sausage factory and you did all the stuff that is needed to understand how the sausage is made. And then you can reasonably go out and, sell your own sausages.
Yeah. But I mean, there are a lot of people who still do that, who also fail at launching a hedge fund. So just because you've worked in the sausage factory doesn't mean you have the right temperament for it. or you
Absolutely.
understand. I mean, there's so many people, this belief that like, if you have alpha, if you can do that over time, that sort of like the, if you build it, they will come.
Right.
But yeah, and I think that that is like totally wrong. So I just be interested in like, did you believe that when you entered? Like, all I have to do is put up the numbers and people will find me. And yeah,
Yeah, I was totally wrong. So, I mean, you probably have interviewed a few people that had a better track record trading options on a prop level. We did great. Congratulations to me, right? It's not where I'm going with this. So I thought that I could use that performance and just like hang out a shingle and everyone like, oh my God, this guy's amazing. And just throw a bunch of money at me. Totally wrong. It is a spurious relationship with your success as a hedge fund. I know people that have way less performance that have raised, multiple billions. And I'm like, really? No. I meet people all the time that run billions of dollars that I think don't have that much IP at all. And tough, right? There is no one path. If there was, it's just like a trade, right? If there was any one path, everybody would arb it out because there's all these ways. Like, how do you find a wife? How do you find a husband? There is no way, right? Do you meet them through church? Do you meet them, at the club, or do you meet them in a hike? There's so many ways you can meet somebody that you click with. And even if you meet them, maybe it's still not a fit. It's the same. And I think that I don't want to discourage people from the hedge fund business, but if you don't already have some money, B, have a plan, and then have a network of people that you can raise with, it's going to be really hard because, you have to bear in mind that the people that are allocating, they're like, the most beautiful woman in the bar. Every single guy in the bar wants to talk to her, right? So she just has nothing but options. And she's like, next, what's your deal, guy? Well, I'm a heart surgeon, not a rocket scientist. Boring. Next. It's like that. It's hard. And if you don't have like every single box checked, you're probably not gonna go home with the prom queen.
yeah. And so, I mean, if you had to say what's more important, relationships, likability, or returns, like what's more important?
That order. Relationships, likability, and returns. They're in that order, not what's most important to least important. And I fallaciously thought it was inverted. I thought that the returns would speak for themselves. And then, if people thought I was a quirky weirdo or I speak too fast, which I do, that they would overlook that. I thought that, much like when I would back people, I would say to them, okay, what's the merits of your trade? I don't really care if you're 6 foot tall, 2 feet tall, 8 feet wide, 8 inches wide. I don't care. I want to know about the merits of, the business relationship that we have. And I mistakenly thought that that would be how it would be for me raising money. And it's not like that. You really have to get to know people. The gestation period for, introduction to actual execution could be years, and who's going to feed your family for these years while these dudes are thinking about it? Or maybe an allocator wants to give you some money, but you want to buy a boat instead. So now you've got all this money mentally spent in your head and poof, this guy's a boat and you have no money. Happens all the time.
Obviously, it differs. Like, but what would you say is the average from an introduction, or somebody coming, filling out a form on your website, or sending you an email to your info at Convex or whatever it is, to getting a check? Like, what is that sales cycle like? Because I think, so many people come in and they're like, all right, show me the results of your marketing strategy or whatever it is. Like, how come we haven't had any checks? It's been 3 months. Um,
So for smaller investors, say it's you, like, it's Max. I want to put in, 300 grand. I've got $30 billion of net worth. I'm going to put in 300 grand into your fund. It's basically a nonsensical amount of money to you and me. It doesn't really matter, but it's a way to commence business. Those things can happen somewhat swiftly. But the real checks that actually have some kind of an impact on the bottom line take no less than a year, probably more like two. If you're talking to an institution, then you have to go through investment committees. They have to align. There's got to be just some level of luck. They have to have been burned by something else, but you've convinced them that, you're not going to burn them on that same idea, or you're so different that it's going to end up being a different part of their bottom line. Because you're almost never talking to the person that made the money. You're talking to a representative, many levels down sometimes, of a pile of money that their only real concern is getting fired or you embarrassing them. Like, everybody wants to give money to Millennium or Citadel because nobody's going to get fired for, giving Ken Griffin more money. You can't because he's closed. But, the idea that if Ken Griffin gets chopped in half, well, half the pension funds in the country have been chopped in half as well. You're like, well, that's just how it goes, right? They're the smartest that there is. And if they got chopped in half, then, that's just, what are you going to do? versus you give money to, a small hedge fund and they go down 10%. You're like, wow, how did these guys why did you give them any money at all? They're down 10% now. Now it's going to hurt our balance sheet by 3 bips. That's the way it's looked at. And it's not as logical as you think. And even if you make, say, 60% in a given year, is that good news? No, that's volatility. So that's too much. So it's like, there's all these counterintuitive things. You've got to be very middle of the fairway with a lot of these allocators. And you really can't be too different, but not too similar. And that part is really, it's an art.
Yeah, and I guess how much of it is solving a known problem for them versus showing them something new? Like when people come and they write a check for you, how often is it they've had a problem with a prior allocation and you are able to explain how you solve that problem for them versus teaching them about this prop world and the way you trade?
You just don't really know. All you can really do is speak to what it is you do. But when I talk to potential investors, I do ask them, like, what else is in the book? What else is working for you? What else is not working for you? Because to me, those are sensible questions. You want to buy a car. Well, what do you want? You want a pickup truck? You want a Ferrari? They do different things. Um, we try to explain that, we do what we do, but we also have a pretty good understanding of the breadth of the marketplace. And, why would you want to give money to me versus Citadel? Right. And, we try to have those answers pre-populated and, those questions pre-populated with answers. So, there is no one way. I know these answers are like, a little bit nebulous and unclear,
No.
but the problem is that there is no one answer. Again, and if there was an answer, you would already know it because it'd be on Twitter or something else. And then everybody would just do that same thing. If the flow of operations was launch a hedge fund, go talk to, Joe Smith because he gives money to hedge funds. Well, what happens? Joe Smith runs out of money. Maybe it's going really well. I don't mean running out of money in terms of like he lost it all. I mean, he just is allocated it all. Right now, that source is, it could be CalPERS, it could be OMERS, whatever. That source is now dried up, right? And then you have to kind of always move around. Well, what's the best stock to own? NVIDIA. Okay, great. But, at some point that's going to change and it has to come up with something new. Maybe it's, you're selling qubits or something. I don't know.
Yeah. So I want to talk about like what the touch points look like. I love to hear that you asked a lot of questions. So somebody has come in, you've developed a relationship, the clock has started, whether it's 1 year, whether it's 2 years. How often are you touching base with people and are you talking about yourself? Are you asking questions about them? What does a touch point look like with a lead?
Well, I think that everybody should read Dale Carnegie's How to Win Friends and Influence People because everybody's favorite topic is themselves. So you always lead with that, whether you're trying to meet a mate, you're trying to get a business relationship or you're just trying to have casual coffee. It's always best to ask questions and answer questions with specificity, which is what I'm trying to do here. But, this is not that format. You're asking me questions, but if this is just a, not on camera dialogue, it is just my nature to ask questions because I want to learn about like, why are we interfacing? What is it that you're looking to achieve out of this relationship? And sometimes it ends up being different than what I thought.
So there's one topic that we kind of touched on off camera before we got going, which is the removing of certain periods of extreme outperformance from your results and managing investor expectations. Obviously, trade options, you traffic in volatility markets, and 2020 was just an off the charts year for extreme outcomes there. And you sent me your track record before, and you said, but we exclude March and April of 2020 because it's just not really relevant to what we expect moving forward. I mean, so many people kill to have a great period of performance and for the way that kind of like juices the, since inception return or the CAGR or whatever it is that is the flashy, top line number that people are looking at. So I'd love to hear how you came to that decision to sort of like remove outliers. And obviously you still have to give people your full track record if they ask for it. But how do you manage that conversation with people who are, really attracted to this thing that is super unlikely to happen again?
So we had just launched the fund right as COVID started. And so I'll give some more context. I was a biochemistry major. I worked in a lab that was right next to a gain of function lab. I've been trained formally in biochemical warfare by the military. So when it comes to things like COVID, I was uniquely suited to have an opinion about it. So our first real trades were buying puts in the S&P 500. Well, what we really did is we bought the first big trade we did. We bought supply, I think it was Broadcom. We bought Volatility in Broadcom because Broadcom is out of sync with the rest of the earnings cycle. I think they had earnings in January of 2020. Um, and no, we bought Broadcom on Apple. That's what it was. And we thought that the thesis was something like, well, Apple was going to come out. Tim Cook was going to be like, iPhones are amazing. You should go buy one. But, there's this new sniffle going around, and we think that, the supply chain will be disrupted. So we thought that, that would happen. And we were wrong. That happened in January. And the volatility that all these options that we bought, we that to zero, right? Close to zero. And so that sucked. So when it came to the first trades that we did, we were really short the market by being long puts, in smaller size than we would have. And it was disrepresentative of how we would run the book holistically. So the returns that we made on a percentage basis of capital were extremely high and not representative of what we would be doing in the future. So we thought it was more honest to say, okay, potential investor, this is what we have and this is what you can expect. But if we have all these insane returns back in COVID, somebody's going to say, well, are you going to do that again in the next COVID? And I can't really tell them that we would, because we didn't have on the parts of the book at that point that would have lost money. So our returns are just not indicative of what investors should expect. Now, I would rather have like a really strong number in my back pocket and show them the rationale and the ethics that go into not putting that our return stream, as opposed to saying like, we just crush it all the time, no matter what. And if the next COVID, we're going to make 1,000%. Not true. And I think that it is the correct thing to do as somebody who has like a long-term vision in his business, to not only perform, but be completely transparent and honest about what has happened and what will happen to the best of your abilities. So if we get a COVID 2.0 tomorrow, do I think that we will make the same returns as we did in 2020? No. That was the real thing. And it wasn't so much that we would underperform. It's that we didn't have on the losers and we did have on the winners. And the vol explosion was so swift, we don't think we could ever repeat that.
Was that because of your understanding of the environment, or just because you'd been so close to launch and just like the money just hadn't been put to work yet?
Both. It was a unique nexus of things that is just really never going to happen again. Again, I was very equipped to understand what, gain of function research looks like, and what effects can be in human beings, how fast can it travel. And I was like, if you took the, 320 million Americans, I'm probably the most worried guy, right? I'm like, well, this is going to be bananas. And then as I started to figure out what was going on with it, we knew about COVID in December. I became like the least worried guy, kind of like walking around licking doorknobs and stuff. Like, I'm going to get it. Okay. Maybe you've already had the Spanish flu from, 1918. I don't even know. Right. But, this thing is going to, mutate. It's going to morph. There's going to be different strains, and, we're all going to, touch it at some point. And whether we die or not, it's just like, whatever. So my whole like investment thesis, shifted, pretty swiftly on that. And, again, we just had a bunch of puts on ASP 500. They paid off gigantically, and we didn't have on other parts of the book that would have gotten hurt. So we decided, from a compliance and a management of expectations, that we should just not include that.
So you talked about, obviously this is a long-term decision for you, for the vision for the fund. We haven't really gotten, that as a holistic answer. So what is the long-term vision? What's the capacity constraint of these strategies? And if you could reach that tomorrow, what would it look like?
Something around $1 billion notional, which really is, a few hundred million of actual invested capital. Then we start to see some alpha degradation. So if you gave me $2 billion right now, would I take it? Yes. Would our returns suffer? Probably. So, but what percentage would it be? 50%? Would it be 5%? I don't know. It depends. Where are we starting at? What's our starting point? If you give me $1 billion tomorrow, well, we're at the end of, the year, as, the VIX is pretty low, the expectations for the future are, pretty reasonable. So it's a harder thing. That's another thing. Like, when we started, we bought a bunch of puts, COVID happened, puts exploded, and then we were able to ride that out. So again, that's just like, man, that's not going to happen again. So don't look people in the eye and tell them that's going to happen again, because it's just not. So we think we can scale for a while, but if you gave me $50 billion, I put it in T-bills.
obviously, if you have this consistent performance, like carry can add up pretty fast if you have a couple of good years on a big chunk of money. Like, why not go back to prop?
Because I want to build a successful hedge fund. I think I can do more with more as opposed to way more with less. And I also have other business lines that I'd like to develop, and that all kind of synergizes. So there's other ideas that I have, and now that I've been around the block, I know that there's all these categories in which people in our business can make money. So my attitude is like, I can do that, I can do that, and those things all kind of interface and touch each other on um, some level. So my ambition is to have more of a holistic business that touches a lot of different aspects of what it is I do.
All right. Well, Noel, thank you so much for coming on the show. It was a pleasure. Sounds like there's going to be a lot of evolution for you, and we'll probably have you back on.
Thanks for having me.